Morning, everybody. Firstly, can I say a huge thanks to you all for taking the time to join us here this morning. I'd like to wish you, your families, and your colleagues a happy and healthy 2014. We have two main speakers here this morning. Marie Hunt, our Head of Research, who will take you through our Outlook presentation, and Marco Hekman, who chairs our EMEA Capital Markets team. Marco will talk about CBRE internationally and developing investment trends over EMEA. Initially, I'd like to talk for a few minutes about the changing landscape in which we work, how technology is rapidly changing our working environment, and how this is nothing new. Indeed, if we look back at history, technological innovation has continually impacted on the property market. An interesting book, first published in 1933, looked at 100 years of land values in Chicago from 1836. The data in this book gives us an insight into how the then changing technologies significantly impacted on the property market. The technologies then were very different to what we see today, but despite this, they were very real in their impact on property values. Examples of technologies that changed the city included canals, the first mass transport system, the railway, linking centres of commerce, skyscrapers, and building technology and how it enabled us to build higher, and the car, leading to the birth of suburbia and how it radically changed where we lived. All of the above developments had an impact on the performance of land values, and that impact hugely varied between one location and another. An analysis of land values in Chicago at this time shows that over the 100 years, that buying a prime site and holding would have given an investor a 6.25% compound return. However, if one traded to take advantage of the differential returns generated by these changing technologies, then the investor could have increased their return to 16.75%. To put this in money terms, $100 invested in buy and hold would have given a return of $43,000, a very attractive return. But the strategic hold for the same $100 would have returned a staggering $531 million. So what does this mean for today? The pace of technological change is accelerating. The pace of change we have seen over the last 50 years is now likely to be matched by similar change over the next 25 years. This slide shows technological change from the 1900s, and if the projections are correct, then by 2023, computers will surpass human brainpower. To understand what the future holds, it's interesting to see what big changes we have seen over the last 50 years. We have short memories. The first shopping centre built in Ireland was built less than 50 years ago. The first retail park, 36 years ago. Since then, we've had high bay warehousing, data centres, air conditioning in offices, and raised access floors. All the above developments have had a significant impact on the property market. So, what does the next 25 years have in store for us? I'm sorry, I don't know for certain. But what we do know at CBRE is that it's hugely important that we continue to invest in our research teams and to speak regularly with our clients, which include 80% of the Fortune 100 and 70% of Europe's top 100 companies, as well as investors who own many of the premier properties around the world. This is going to help us better understand how these changes will impact on property market. Doing this dramatically improves our ability to give our clients the best advice possible. So what do we need to look out for? Do we continue to design offices as we have in the past? CBRE is an occupier implementing these new space utilization opportunities with their in-house design teams, such as remote working, untethered, hot desking, sit-stand workstations, treadmill desks, etc. My colleague Tony Grant and his building consultancy team are at the forefront of implementing this change. 3D printing. Where and how will products be manufactured? Drones may sound fanciful, but when you think of the much smaller carbon footprint of a drone against a man in a van, you can see that this technology will change how we do things. Cloud computing. data centres to become a defined property sector, just like retail warehousing has. My colleague Gareth McLean has led the way here in this new market. Social media and smartphones have had a dramatic impact on retailing in particular. Maybe I could ask for a show of hands of how many people have heard of a company called Pinterest. Anybody? A lot more actually than I thought. Well, Pinterest is a 3 billion e-tailing company with an average conversion of click to sales just behind Facebook, but twice that of Twitter. In 2013, $1,200 per person in the US was spent online, up from $60 in 2000. Nanotechnology. The materials and how we build buildings will change. Glass can become a structural component in the future. Megasheds, Marks & Spencer's have gone from over 100 distribution centres in the UK to now just a handful of megasheds. Some of this change may not be for the best. The idea of ordering a pint from a robot could put us off drinking forever. But it's interesting to see Google recently acquire one of the leading robotic companies in the US, and over the last few years have acquired 7 such businesses. I was talking to my colleague Sean O'Brien recently, and one thing we share in common is that when we started work, our first desk had a bin and an ashtray, no computer. Indeed, in my first office, there wasn't a photocopier. We've come a long way. Thank you once again. Thank you.
Good morning, everybody. I'm just watching that video and remembering growing up in Mayo in the 70s and the 80s, we still had a shop that travelled around door to door once a week. So we've come a long way in the last 25 years. 25 years is a significant number because we're launching today our Outlook 2014 document, and you'll all get a copy as you leave. It's our 25th edition, the first edition being produced in 1989, so it's a big one for us. I think looking back at the year just gone, it's very important to say that 2013 marked a major turning point for the Irish property market. The process of deleveraging continued with many loans and portfolios and individual assets traded over the course of the year. Sentiment improved both in terms of the economy and indeed the property market. And of particular significance, we saw a very notable increase in transaction volumes in almost every sector of the market, to the extent that by the time we got to mid-year last year and we were running our numbers for Q2, we actually had exceeded the previous year's numbers. And you'll see that in some of the charts as we go through them this morning. We've obviously had no speculative development whatsoever in the market for many years now, and that began to turn into supply shortages of prime stock in some sectors of the market last year. We also had rents stabilising, and indeed in the prime office sector we saw rents rising by 25% in the calendar year. Yields hardened significantly over the course of the year, with some sectors seeing yields coming in by up to and exceeding 100 basis points over the course of 2013. We also had the establishment of Ireland's first 2 REIT vehicles. We had the extension of the capital gains tax waiver for an additional 12 months, and psychologically important, the IPD index moving into positive territory for the first time in 6 years towards the year end. So I think you'll agree it was a major stepping stone. That's not to say there aren't legacy issues to be dealt with and to be tackled. Our economy is still susceptible to a lot of the macroeconomic developments. We have a lot of issues still to tackle. But I think the stage is set for an even busier 2014, with the improving economic backdrop and some improvement in the availability of bank funding. I'm just going to bring you through some statements about the market. I'm not going to read them out, but you might consider. The first one is talking about the increase in transaction volumes. The second one is talking about international investors looking at investing in Irish property. The third one is talking about a general improvement in the economy and how that is linking to renewed confidence in the property sector. All of these 3 statements, I didn't write them. They certainly weren't written any time lately. These came from our very first document in 1989, written by the late Fintan Gunn, who obviously had great insight. But clearly, I think, talking about increased transaction volumes, international investors and economic improvement, all things that are as relevant now as they were 25 years ago, it certainly proves a point we've been making on stages like this for many years, that the property market is cyclical. And indeed, another statement lifted from that document demonstrates that, talking about history and cycles perpetuating themselves. Enda talked about trends that are affecting the market, and many of the words that are going to come up on the screen now, hard to believe, but 25 years ago they didn't exist. We didn't have social media. We certainly had never heard of Twitter or Facebook. Words like NAMA, we had no clue what that was. REITs. And here we are 25 years later, and these are the words that are influencing what we do day to day in our work in the real estate industry. If we were to pick two words on there that are going to have the most significance going forward, it's going to be technological change, as Enda said, and globalization. These will dominate the real estate cycle and each sector of the market in a variety of different ways. We're going to talk about each sector individually because obviously they're all different in their own right. And I think 2013 was unusual in that in every single sector the market improved, and that in itself is unusual because property doesn't really work in that way normally. You can have one sector performing well while others are not so well, but every single sector saw an improvement last year. So starting with the office market, I think you'll all agree we had a very, very strong volume of activity last year. We're continuing to see foreign direct investment coming into this country. We're seeing quite a lot of expansion. And in terms of who did deals in Ireland last year, we had 184 individual leasing transactions. 34% of that came from US companies, 35% from Irish companies, which might surprise some people, and the remainder coming from other jurisdictions. The two sectors that were most dominant were computers and IT and financial services, accounting for almost 50% of the entire 170,000 square metres of take-up between them. So at 170,000 square metres, or 1.8 million square feet for anybody who still talks in feet, that is above the 10-year average. So anybody who's saying the office market is not performing, we had a higher volume of transactional activity than the 10-year average last year, and the expectation is for a similar volume of activity this year. 70% of all of the leasing activity that happened last year was city centre focused, with the suburbs picking up the remainder. I mentioned rental growth, and obviously rents in the prime office sector have fallen very significantly from peak. In fact, they fell by more than 55% from their heady heights of €673 per square metre or €65 per square foot back in 2007, all the way down to about €27.50 per square foot, €296 per square metre. It won't be hugely evident from this chart, but rents actually increased by 25% last year, ending the year at €377 per square metre or €35 a foot, and they're fast heading towards €40 a foot. So very quick turnaround in a very short space of time. Just flicking back to the previous slide for a minute just to show you the vacancy rate on there, that was another dramatic change last year. We started the year overall with a vacancy rate of over 21%, and we ended the year at precisely 15.3%. So that change happened over the course of a very short period of time. But as you know, when we talk about vacancy rates, it's very important to break it down into the sub-markets and to look at grade A vacancy versus secondary. And as you'll see on this chart, you do get a very different picture. So if we look at Dublin 2-4 there, the overall rate of vacancy at the end of last year was over 11%. But if we strip out all the secondary and not really fit for purpose buildings, we get a vacancy rate of 4.5%. So that's why our headline rent rate is starting to increase. What's our expectation for this year? We're continuing to see foreign direct investment. We had Enterprise Ireland bringing out great results yesterday, IDA bringing out great results last week. So there doesn't seem to be any end in sight in terms of companies looking to expand and set up operations here. And we also have Indigenous company expansion. So another strong year is certainly in prospect. Last year, the main, I suppose, beneficiary of the recovery was the prime headline market, but we could see that filtering down into some secondary and provincial markets this year, and we expect to see rents in some secondary markets, particularly in the south suburbs, likely to experience some uplift in 2014. The year will be significant because we'll see the crane coming back onto the landscape. Any development that does start is likely to be supported by pre-lettings, but we could also see some speculative development coming on stream. And I suppose the significance of rents heading towards €40 a foot is helping that development look feasible again. Obviously, to develop, we need funding, and while there is some improvement in funding, it's proving difficult to get development funding. So most of these new projects that are going to come on stream are likely to be funded by private equity funds as opposed to the traditional banks. If we look at availability, which is the vacancy rate, we would expect to see that coming down further, and we're forecasting that the overall rate of vacancy will probably end the year at about 13.5%. We're also going to see an improvement in refurbishment and redevelopment projects, and again, probably mostly funded by private equity players, although some of the banks are beginning to look at this as well. So further rental growth on the horizon as well. We're forecasting a 15% uplift to bring rents to €40 per square foot by year end. I think it's fair to say that tenants really have had the upper hand in negotiations in many sectors over the last few years, but particularly in the office sector. And we would expect to see that changing quite a bit this year and the balance of power moving back more towards the landlords. So for any solicitors in the audience, you're going to have much more intense negotiations over things like lease lengths, break options, rent-free periods. It's going to get tougher out there. Another significant development that's going to happen in 2014, I know we've been talking about it for some time, but the Strategic Development Zone, the SDZ at Dublin Docklands, is expected to be enacted by mid-year. And that will mean that development can kickstart in this strategic location where many of the occupiers have a preference to locate. We saw the emergence of the commercial lease database during 2013. Now, I don't know that it's had much of an impact as yet. It certainly has a lot of tweaking before it's anyway meaningful. But hopefully over the course of the next 12 months, we'll see transparency improving, and it's much needed, particularly in a market where we've a lot of international investors wanting to come in and do very detailed due diligence. We absolutely have to get that right. And in terms of technology, obviously, huge implications for the office sector going forward, and Enda has alluded to some of those, such as remote working and hot desking. So we need to be thinking ahead as to how this is going to shape the demand for office accommodation going forward, and indeed how we use buildings. Moving on to the retail sector, I think it's fair to say of any sector of the market, retail has taken a much bigger hit than anything else because of its links with the general economy, because of its links with consumer confidence. And certainly looking at retail sales, certainly if you're looking at on a month-on-month basis, they're not very exciting. They go up one month, they're down again the next. But I think if you look at them on an annualised basis, we're beginning to see the first signs of improvement coming through. The November numbers, which are the most recent ones, showed a 1.7% increase year on year. And I suspect when the December numbers come out, it will be even stronger because many retailers and many of our own clients had a good Christmas trading period. Clear signs of improvement starting to come through, but I think it is fair to say that the main beneficiaries of that have been the major high streets and the major shopping centres who've continued to see good activity last year. We have yet to see that filtering down, but we could well see some recovery starting to come through into secondary centres and secondary locations and indeed provincial centres in 2014, with a reduction in the overall rates of vacancy in some of our high streets right around the country. Much of the activity in retail over the last couple of years has been very dominated by the discount retailers, and that's probably no surprise considering the economic backdrop. But we're beginning to see that change, and we would expect to see an increase in high-profile brands, a lot of international chains looking seriously at setting up Irish operations over the course of 2014, something that we began to see in streets like Grafton Street last year with new entrants like Levi's, Cat Kitson, Massimo Dutti, setting up their first Irish stores on the street over the course of the year. We expect to see new entrants to the market that we haven't seen before, but we also expect to see existing retailers expanding, and we expect to see the first signs of rental growth coming through. Now, that's not to say that we're going to see rental growth across the entire retail sector. I think it will be very much limited to absolute prime high streets and prime shopping centres, particularly where there's competition for particular units. But it's the first sign of rental growth we've probably seen in about 6 years in this particular sector. We'll see some selective development as well, but mainly taking the form of extensions to existing schemes, for example, extensions to Tala Shopping Centre and Liffey Valley, which are on the cards. The speed of technological change, I think the retail sector has clearly seen over the last few years as people move more and more towards an online platform. It's something we need to be very mindful of. It's not killing the demand for physical stores, but retailers really have to be fully tuned into the new sales channels that are out there and changing consumer habits. So in addition to their physical store, they have technology in place to enable to drive their business. And I suppose against that environment, it's important to say that the speed of the need for intensive asset management has absolutely never been more critical than in the retail sector at the minute. That's not to say retail as a whole is going to improve significantly this year. I think we are going to see an improved market, but there's still a lot of problems out there, and depending on what sector of retail you're in, it can be quite challenging. We also have the new examinership light legislation which came in to being just before Christmas, so it remains to be seen if other retailers will follow the examinership route over the course of the next 12 months. Moving on to industrial and logistics, and as you know, industrial and logistics is a very specialised sector, and activity in this sector has been very strong over the last number of years as well. And indeed, looking at our own take-up stats, take-up for 2013 came in at 296,000 square metres, which was up 50% on the previous year, and a similar volume of activity expected this year. The three dominant sectors that are driving demand in this sector are data centres, logistics companies, and pharmaceutical companies. And interesting, most of the data centre activity that we're seeing is actually not in these numbers because those occupiers have a preference for buying sites and developing their own bespoke facilities, so they're never going to appear in our take-up figures. Our expectations for this year is that take-up will match, if not exceed, the volume of activity we saw last year. We're also going to see the first gradual increase in industrial rents in 6 years in this sector, with prime Dublin industrial rents likely to hit €6.30 by year end as we slowly absorb a lot of the prime modern accommodation, particularly along the major road networks. However, at those sort of rental values, speculative development doesn't add up, so we're very unlikely to see any speculative development in this sector for the next 12 months. There's a lot of demand out there for good service sites, and I mentioned data centres, but equally there's lots of owner-occupiers who have such specialist demand for buildings that there aren't really that many options out there in terms of current availability, so they will pay a premium to buy good service sites, particularly those in close access to the M50 and road networks, in order to develop their own specialist bespoke facilities. Technology is going to have an impact on this sector as well. You might wonder why, but if we're moving increasingly towards online retailing and the development of a national postcode system, it is inevitable that we're going to have to provide the buildings to enable this online retailing to take place. So logistics facilities to service the delivery of goods. And apparently about 20% of everything that's bought online is returned. So we also need to provide what are called reverse logistics facilities to enable the goods to be sent back to where they came from. As some of you know, I'm involved with a charity outside of CBRE, To Russia with Love, and we recently ordered quite a lot of goods from Russia, and we were waiting patiently for them to be delivered. And I came home one day and got a note on the door to say I'd missed the delivery, but if I was willing to travel to my local dark e-fulfillment centre, I could pick up the goods. Now, the dark e-fulfillment centre was an industrial unit up in Ballycoolan where you drove in, and the reason why it was called dark is that all of the goods are brought by robots, and apparently they don't need lights. They can shoot up and down the aisles and pick the goods out without lights. So dark e-fulfillment centres. Industrial investment activity, I think it's important to say that up until now, industrial hasn't really been a mainstream investment class. Most investors in Ireland tend to focus on office buildings or retail buildings. Only about 1% of the entire investment spend last year was industrial buildings. I think there was only about 5 industrial investments completed over 1 million in value in the calendar year. But we would expect to see that changing because investors are moving up the risk curve, and we would expect to see some of the institutions and indeed maybe some of the Irish REITs looking seriously at logistics and industrial and data centre type investments. The investment market, I think, has probably led the recovery that we've seen in the last 12 months. It's the one where we've seen most change in activity and most increase in transaction volumes on an annual basis. This is the IPD index, I suppose, clearly demonstrating that 2008 and 2009 was when the market here was at its worst. We've now had 8 quarters of positive capital growth, and as I mentioned, very significantly in the third quarter, which is the most recent data available from IPD, total returns went positive, and I think that was the first time in many years we'd seen that happening. So psychologically that's important because a lot of investors, particularly those from outside of Ireland, pay huge weight to IPD. We track yields ourselves. Now, these are prime headline quoting yields, and you can see very clearly the pattern of what has happened over the last number of years. But just pointing you towards what's happened in the last 12 months, most sectors saw yields moving in by about 100 basis points, driven by improving occupier markets, prospects of rental growth, and the sheer weight of capital chasing deals, to the extent that by year-end 2013, yields in every sector are either close to or at their long-term averages. So what does that mean going forward? Clearly we can't experience the same volume of yield compression again in 2014, or we're going to price ourselves out, and many of the international investors that are looking seriously at Ireland will just look elsewhere. But I think it's important to put it into context, and I think one of the benefits of being part of the global CBRE network is that we can compare and contrast our yields and our rents with many other jurisdictions. And I don't know if you can see Dublin, it's about midway across in the middle of the chart. So this clearly points that we're still competitive relative to many other European cities. And I suppose the challenge for 2014 is to stay competitive. If we look at transaction volumes, you can see very clearly that the big jump that we saw in the last calendar year, and indeed from the low point in 2009 when there was only 92 million spent on investment properties. The total for last year came in at 1.78 billion in 96 individual transactions, so it more than trebled. Now, if you add in loan sales on top of that, specifically Irish loan sales, that comes to another 750 million. So added together, about 2.5 billion of liquidity in the market last year. Now, people will say, well, at the peak of the market, it was 3 billion. I think it's important to say at the peak of the market, it was 3 billion. It was almost all domestic, but it was almost all debt. Whereas we're in a much more comfortable position now. We have a lot more equity in deals, and I suppose international investors, which we haven't had in the past. Arguably, when you factor in the extent to which values have fallen, liquidity is even higher than it ever was. What were the deals? It's very much office dominated. In terms of this particular chart, 39% of that 1.78 billion comprised pure office buildings. But if you look at the mixed use section, that includes a lot of the portfolios that traded, and as you know, most of those were heavily focused on offices as well, so the true office figure is actually higher. Retail only accounted for 7% of the spend, but surprisingly there were 25 deals over 1 million in value. So that tells us there was a lot of deals, but they were relatively small in size. Obviously, if Liffey Valley had signed before year end, that would have changed the picture somewhat. The value of deals, interesting, everything over 1 million in value. 62 of the 96 were actually less than 10 million in their own right. And we have a new segment popping in here now, 3 in the purple segment, which is deals over 100 million in value. And the 3 that are in there are obviously Project Arc, Project Opera, and Project Ulysses. Another big change compared to 1989, everything seems to have a code name now, which certainly wasn't the case previously. We track where the entity that buys the asset is located, and it's not easy, but we have determined that just less than 50% of the investment spend last year was Irish. Quite a lot of the money coming from other jurisdictions. Now, it's important to point out as well that in the previous year, 70% of the spend was international. The reason why the Irish section jumped a little bit was because we had Irish institutions actively buying in the last 12 months, and we also had the entry of new Irish REITs. They're Irish entities. Obviously, the money is not Irish for the main part, but they're Irish entities, so that's the way that's tracked. And this is clearly showing you the trend of globalisation, and I'm sure Marco will allude to it as well. We're not the only ones seeing this international capital chasing deals in our own market. In terms of the investment market for the year ahead, I think the big concern that people will have is about the pace of supply coming to the market. We have banks and NAMA still continuing to deleverage. Some new entities that haven't deleveraged significantly yet will be ramping up. You also have the retrading of some of the assets that were bought by private equity buyers and loan buyers over the last number of years. So the big concern is there going to be too much stock coming to the market at any one time? And hopefully that isn't going to be the case, and hopefully we will see supply coming on a controlled basis, because it's in nobody's interest to have supply coming on too much. We need to feed the demand that's there, but on a controlled basis. We would expect to see an even higher volume of transactions than we saw in the previous year in 2014, for no other reason, but we were still launching assets for sale in November and December, and many of those deals didn't close by year end. So quarter one, which is never normally a strong quarter, is actually going to be strong, and there's going to be quite a lot of spend. So for that reason alone, we're probably going to have a higher volume of transactions this year. What's driving investors? It's largely the prospects of rental growth. They've seen significant rental growth in offices last year. They can see further growth coming down the line, and obviously the potential for further yield compression, albeit that is probably limited, being that yields are at or close to their long-term averages. Although we think that the likelihood is that the pace of yield compression will level out over the next 12 months. Investors have been playing it safe a little bit over the last couple of years, sticking to very dry income-producing assets. And I think what we're likely to see this year is investors starting to move up the risk curve a little bit and maybe look selectively at buying secondary assets. Maybe not secondary in terms of location, but certainly secondary in relation to the quality of buildings. We're also going to see an increase in investment in non-traditional sectors, so moving away from the reliable office and retail sectors into specialist sectors like student accommodation, logistics, data centres, healthcare. And we also would expect to see the multi-family residential, which didn't exist 3 years ago, becoming a much more mainstream part of the market. And indeed, if you remember back to a few slides back, residential accounted for about 9% of total investment spend last year in terms of multi-family. So certainly a mainstream sector going forward. A number of years ago, when a lot of the international investors started to arrive on our shores and look for opportunities, the domestic players saw them as competition and were a bit concerned about them. But I think that picture has changed, and we're now looking at them as potential partners on deals. And I think we're likely to see more partnerships between domestic and international players, more joint ventures over the next while, both in terms of buying loans and indeed assets. We're going to see the re-emergence of forward funding in 2014 as the next phase of development kicks off. Will that funding be provided by banking, or will that funding be provided by private equity? That's the question. There's, in any event, going to be greater competition from banks, because even in the last number of months we've seen increased competition from non-Irish banks to get exposure to the Irish market and the Irish recovery story. We saw the emergence of 2 REIT vehicles last year, the Green REIT, the Hibernia REIT. We're going to see more in 2014. Now, obviously, we have a small market, so it's not an unlimited number, but certainly there will be more REIT vehicles and more Irish entities converting to REIT status, and we could well see the existing REITs going out and doing additional fundraising over the next while as the demand for more indirect investment increases. Now, against the backdrop of an improving occupier market, it's no surprise that there was a significant jump in the volume of activity in the land market last year. And indeed, if we look at the volume of non-agricultural sales as we track them, we had almost 200 million, 199 million to be precise, of non-agricultural land sales last year. 75 individual transactions, which is higher than it was even in 2008. but you can see clearly that the extent of value destruction that's happened in that sector. But a fourfold increase year on year, and the beginning of the first phase of development. And this is an image which was taken during the week of just across the street on the Vet College site where development has kicked off, and there's intense piling going on over in that site at the minute. So this is the first phase of the next development. What's driving the demand for land? Obviously, it's improving occupier markets, particularly in the office sector and commercial, and equally in the Dublin market, the supply-demand imbalance that exists on the residential site. That's what's driving the demand for sites. And as rents and values increase, development is actually looking feasible again in some cases. We would expect to see land prices continuing to improve in Dublin over the next 12-month period. And the extension of the CGT waiver, which we mentioned at the beginning, it is important for many sectors, but it does have a big impact on the land market, where a lot of the buyers are domestic and they're driven by this exemption that is in place for an additional 12 months. We think that the supply of land is going to increase. Much of what traded in the last number of years has been small infill sites. We would expect to see some larger sites coming to the market this year, and in some cases they're going to be part of some of the mixed-use portfolios that are coming for sale. And obviously a lot of the loan portfolios that traded over the last number of years did include land, so ultimately they're going to come to the market and be sold as well. In an environment where development is in some cases looking feasible again, there is going to be increasing pressure on the domestic banks to start providing development funding again. But I think the private equity players are at the minute soaking up quite a lot of that demand, partnering with local developers. But I think there is going to be increasing pressure on banks to start looking at potentially providing development funding again. One controversial issue is this vacant site tax, which is going to be potentially introduced over the course of the year. An audit was done in Dublin City Council over the Christmas where they identified 60 sites that haven't been developed, and potentially putting a levy in place is what government are proposing to encourage people to go on site and start developing these. We think it's a dangerous move because there is going to be a considerable backlash if this tax is introduced. Taxing people in order to stimulate demand in a location where development isn't feasible in the first place just doesn't make any sense. We also need to see relaxing of densities in local authorities, so it was encouraging to see Dublin City Council relaxing densities in 3 locations in recent months. Hopefully we'll see other local authorities following suit. And finally, just to look at the hotel and licence sector, which again had a very, very strong year, boosted by the gathering and a significant uplift in tourist volumes and tourist numbers. We also saw a lot of assets coming to the market in the hotel and licence sector. We had 33 hotel sales in the calendar year, 159 million. That mightn't sound like a lot, but if you consider back in 2007, 2008, how many assets were trading, and the fact that in 2009, in the entire country, only 2 hotels sold. If we look at the geography of where the buyers are coming from, 13 of the 33 sales that happened were overseas buyers. But in actual fact, that accounted for more than 86% of the value, because a lot of the very larger trophy assets that were brought to the market were bought by non-Irish entities. So more and more geographies looking seriously at the hotel sector. This was a sector where many assets actually came to the market in October, November, December. So we've come into 2014 with a significant carryover of deals that didn't close before Christmas but are going to sign in the coming weeks and months. So transaction volumes for this sector likely to be even stronger again. There's going to be several high-profile Dublin hotels, including some in the city centre, and some well-known provincial hotels going to be coming to the market. I know a lot of discussion in the paper about Doonbeg today because that went into receivership yesterday, so likely to be brought to the market for sale. But there will be others, and we could well see portfolios of some hotels coming to the market as well. This is also a sector where the extension of the CGT relief will have an impact. It will stimulate from demand from domestic investors. Not that they're going to go out and buy a hotel purely because there's a CGT waiver in place, but it certainly will aid their decision making to get a deal done by year end in order to avail of that relief. Many of the overseas purchasers who bought here didn't come here to buy one hotel, so we would expect to see some of them buying again, and we also will see some new entrants to this sector. We're going to see the first signs of hotel development kicking off again. And as you know, many hotel projects in the Dublin market went through the planning process last year. So ultimately, they're going to go on site and start developing. We're not going to see that being replicated around the country, but certainly within Dublin, we'll see a number of hotel projects commencing. We also saw a surge in activity in pub sales last year, particularly in Dublin and major urban centres, and we expect to see that continuing because obviously a lot of deleveraging has to occur in that sector as well. Many of the pubs, for whatever reason, that were traded last year were closed down for various reasons, but what we would expect to see this year is an increase in the number of actual trading pubs coming to the market, and that's important as well. We saw the first entry of some UK entrants like Wetherspoons buying their first pubs in the Irish market last year. We think they'll buy again, and we would expect to see some other UK entities following suit. Some improvement in funding in this sector is important because obviously in the hotel and licence sector you do have to spend money on refurbishing and capex. But we had 8 million visitors last year. The VAT rate is retained at 9%. The air travel tax is abolished. And there's a lot of new air routes opening and a lot of big events planned, particularly for Dublin. So all in all, it seems encouraging. We're going to put our neck on the line a little bit now and try and look a little bit further out because particularly with a lot of the international investors coming into Ireland, the first thing they ask is what our forecasts are. And we tend to only ever look a year or 2 years out, but we've tried to simulate what might happen with rents and with yields. And this is all done in econometric modelling in our EMEA office. So I'm going to go through each sector and just give you a flavour of where rents were, where they are today, and where we see them going. So if we look at the absolute peak of the market in Dublin, rents hit €673 per square metre or €65 per square foot. They bottomed out at €296 or €27.50 in square feet terms, and today they're at €377 or €35 a foot. We feel they're going to hit €40 a foot by year end 2014, and if they follow that pattern out to 2020, we'll be back at €58-59 per square foot by the end of the decade, which is still less than what it was at the peak, I might add. Now, it is important to say that rents rarely move in a straight line in this fashion. They do move in jumps and starts, but ultimately we think we'll be at €58-59 per square foot by 2020. What's going to happen with yields? If we look from the period from 2000 up to the present day, the average office yield in Dublin prime office has been 4.91%. So today, we're at the end of 2013, we're at 5.75. So we're still a gap there from the long-term average, but we're quickly heading towards 5.5%, and we could well see further sharpening of yields. So we're still okay, but back to the point we made at the beginning, we have to remain competitive. Our expectation is that we'll end the decade at 5%, and I suppose going back to the late Fintan Gunn's comments at the beginning about the cyclicality of property, we're going to end 20 years later at the same yield we started with in 2000. Looking at the industrial market, prime rents hit €10.75 at the absolute peak, went down to €5.50 or €60 per square metre. Today, at that level still, likely to hit €6.30 by the end of this year, and we're forecasting we'll be back up at around €10 per square foot or €108 per square metre by the end of the decade. Prime industrial yields today at 8%. At the peak were 4.75, which seems remarkable now. They're at 8%, the long-term average 7.75, and likely to end the decade about 8.25. In terms of rents, I think it's important to say that the measure we're using here is a Zone A rent on Grafton Street. At the absolute peak, this was €10,000 per square metre, which at the time was out of kilter. I think it was next to the Champs-Élysées in terms of rent, so we were completely outpricing ourselves at that sort of rate. They fell much more dramatically than in any other sector, currently around €4,000 on a Zone A basis for Grafton Street. Not increasing anytime soon. We could see some uplift in 2014, as we said, but likely to end the decade at just over 6,000 per square metre, which is still considerably less than the sort of values we saw in 2007. And looking at yields in this particular sector, at the absolute peak, again, seems remarkable, 2.5% yields for retail on Grafton Street. over-corrected to about 6.5% and have been steadily coming in, today at about 5.5%, which is exactly the same place where prime office yields are at present. So just before I conclude, I think it's important to say it's very, very difficult to try and look out to 2020 and imagine what the world might be like. We talked about the words that didn't exist in '89 that are shaping the way we work today. These are the words that are going to shape the way we're going to work over the next number of years, because technological change and globalization will shape real estate. Whether you're an occupier, sorry, I didn't mean to hit that. Whether you're an occupier, an investor, a developer, and technology is going to influence the way that you own property, the way you occupy it, the way you plan it and design it, the way you develop it, and indeed how you manage it. So we can't underestimate just how much a change globalization and technology are going to have in the real estate sector. It's going to change the world as we know it, but equally it's going to give rise to opportunities. And I think that's why you need a global brand like CBRE, who are spending the money and the time on research and development, looking ahead, trying to anticipate the trends and what they're likely to mean for the real estate sector today. And I think on that note, we're very, very lucky to have Marco Hekman, who's the chairman of our EMEA capital markets business, with us this morning. He will give you a short insight in terms of the scale and the capabilities of CBRE, and also give you some overview of the trends that are going on in real estate sectors outside of our own Irish market. So thank you very much, and I'll now let Marco come to the stage. Thank you.
Good morning. Good morning, Pat. My name is Marco Hekman. I'm Dutch, so hence my accent. I'm chairing the EMEA capital markets business within CBRE, and I'm also looking after the Dutch business. Marie and Enda have asked me to explain a little bit about current developments within CBRE, as well as some trends in the capital markets business in Europe. And that all in 10 minutes. So I'll try to be short and to the point. If you look at at CBRE, we've had a good 2013, and if you look at our share price and at the share price of similar listed companies in our sector that have increased with about 30% last year, it's typical indication that the markets will pick up. And CBRE is a business that invests all its profit into the business, and that has led to a number of acquisitions last year. Some smaller ones and one larger one. Two small ones in London. They are residential agencies. We bought a number of property management organizations in Sweden, in Belgium, in the Czech Republic. And we did a very large acquisition very recently. We bought a company called Norland. And I understand there are two of my new colleagues, which I haven't met, in the room. And we're very proud that we've bought them. It's a company which is for us a large acquisition. It's a company that is providing technical engineering services for really major occupiers, mainly in the UK and Ireland. They have about 4,000 employees, a turnover of over $600 million, and 14 offices in the UK, Ireland, I think two outside of this region. We see that our clients are seeking to consolidate their supply chain by selecting a single property advisor who can do all the services they need. And this was for us a business which is really adding to our platform. Needless to say, it's not all about size. We try to be the best in class and deliver premium service. And if you look at our business, you can distinguish two clear areas. An area which focuses on occupiers and an area that focuses on investors. And if you look at the occupier services, these are typical services that are relating to leasing and buying for occupiers, but maybe less known, but very fast growing, is facility management, project management, and as Enda already mentioned, the implementation of new workplace concepts. And please don't underestimate that. At the moment, there are very, very few occupiers that are not thinking about new workplace concepts. And as a matter of fact, CBRE has rolling out a whole program, and all the offices will be, the whole new work method will be globally implemented. 2 years ago we started in Amsterdam, Sydney has been done, Singapore has been done, Madrid has been done, and very recently in November our headquarters in Los Angeles has been totally changed. That's where you can find the treadmill desks. Don't know what they look like, but it sounds nice. On the other side, we have, say, the areas, the business lines that are focusing on the investor business. Probably well-known, buying, selling, leasing, managing, valuing for our clients. But fast-growing there is our loan sales platform, our loan origination platform, loan servicing platform, as well as the equity raising team. Typical activities you would maybe expect 5 years ago to be with investment banks, and we see now that these activities are being done more by companies like ourselves, and obviously we think as a much better fit within CBRE, because it's, at the end of the day, it's all about the underlying assets. In short, we want to be your preferred business partner for all your real estate needs. Enough about CB. More importantly, where's the market going now? If we look at the overall economy in 2013, we virtually haven't seen any growth in the European region, with the exception of the UK and Poland. Negative growth in Italy, Spain, Ireland, Holland, or virtually no growth. But according to Oxford Economics, if you look at the coming 2 or 3 years, almost all of Europe is turning green. And some countries are even turning dark green, which is even better. More growth, more than 2%. And that's expected to take place in Ireland, the UK, Central Eastern Europe and the Nordics. Holland and Italy are lagging behind a little. But overall, this is looking really good. And some of our clients have already anticipated this growth. And if you look at how much money has been invested into the commercial real estate markets in Europe, then it's still an estimate, but it will likely be a little bit more than less. In last year, in 2013, just over 150 billion euros in real estate has been invested in the European markets. Still less than 2006 and 2007, but at similar levels of 2005, and it's an increase of roughly 20%. More important is the next slide if you split out the equity from the debt. And then you clearly see that 2006, and that's no surprise to anyone here in the room, 2006 and 2007 was clearly driven by debt. But 2013 appeared to be the highest amount of equity spent. And that was certainly for me a surprise. 100 billion of equity was spent in the European markets in all sectors. Again, a 20% increase. And if the debt markets are coming back, we could be in for a huge jump in activity. And if we talk about the debt markets, we see a number of trends. Local players in the smaller countries, the local banks, are not really lending anymore, with the exception of Belgium. If you go to the bigger markets, UK, Germany and France, you see that the local banks are playing in the debt markets. The withdrawal of lenders to their home countries, we expect that it's going to reverse. We see now UK lenders going outside of the UK. We're seeing German lenders going outside of Germany looking for margin. We even see French banks going outside of France. And another trend is that institutional investors like pension funds and insurance companies are going direct in the debt markets, whereas in the past they went through commingled funds, and you have institutional investors now like MetLife, AIG, Prudential, Legal & General, AXA, Norge. They're all in the market with very different programs. Where they were initially focusing on the core real estate, they now are very different, and some are going very much more up the risk curve. And nowadays, they all have specific profiles and even pressure to lend, and this will lead to the fact that they will be taking more risk. And as a conclusion, I think the debt markets, what we expect, is that it will look much more like the investment market than it has ever done, a little bit like the US model. So where have we seen the biggest change in investments? The big change has been seen in markets like Italy, Spain, Portugal and Ireland, almost doubled the size of their investment activity. Average in Europe was about 20%, Germany just on average, UK and CE have really seen a big increase, 30% compared to 2012. In France, we have actually seen the reverse. It's going down. It's an unpopular president at the moment, and since last weekend we know that he hasn't been focused on totally other things than on taking austerity measurements. And also the Nordics, we've seen that it's going down a little bit, but they've had a big 2012, and we don't think that there's fundamentally anything wrong with that area. The good news is that there's more cross-border activity, and cross-border investors are coming back and investing more in our region. And if I just may touch on a few countries and why we expect that that will increase over the coming years, then that has, for example, in Australia to do with the fact that the pension fund system has changed. In 2002, they changed the pension fund system a little bit like the Canadian system and the Dutch system, and that is going to lead to a huge amount of extra money that will be invested. I think the current volume of the pension funds, they now have about 1.5 trillion of assets, and the expectation is that that will go to 4 trillion in 10 years from now. If we go to Japan, we really expect that the Japanese investors will go back to the European real estate markets. They've been here in 1985 to the beginning of the 90s, and then totally exited the market due to their property crisis. We expect they will be back. There have been conservative investors since then, but even if they allocate 1% more into real estate, that would lead to a net investment of about $140 billion into direct real estate, and they will definitely be back. And then obviously the Malaysians have been big investors in London, Singapore and Australia. They have played a major role also last year in the European markets. Koreans typically going through investment managers like Deutsche Bank, Jones Lang LaSalle, CBRE Global Investors, Rockspring, Heinz, etc. You can't talk about Asia without talking about China. In October, November 2012, the Chinese government has allowed insurance companies to invest 15% of their total assets outside of China. And in 2013, that has led to a number of large deals, especially in London, but also in Belgium, and I have an example a little bit later, and we see them also in Portugal. So there's no reason why they wouldn't be investing in the coming years in this market or in other markets like Spain, Italy, and Holland. Then a similar trend we've seen in Taiwan, where the government is trying to release the pressure a little bit of the local markets there. Prime yields in Taipei are about 2.2%, and insurance companies are now also allowed to invest about 10% of their total assets outside of Taiwan. And we've estimated at CBRE that about 2.6 billion of that will be invested into the European region. Middle Eastern have been a very large investors, young population, very fast-growing population, and there will also in the future will be a lot of money coming from the Middle East. If we go then to the other side of the pond, go to the United States, we've seen American investors all over the place in Europe. We've seen them here, we've seen them in Holland, they're active in Italy, Germany, especially the private equity firms. And at the beginning, just after the crisis, they were the first ones to invest in New York, first ones to invest in London. It's actually interesting to follow the private equity firms because you see them now selling out of these markets and investing in markets I just mentioned. And Canada, maybe I should mention Canada as well, a big pension fund industry, allocation to real estate, which was typically 5 to 10%, and it seems that they're going to increase that from somewhere between 10 to 15%. And that will lead to a lot of money which will push towards this part of the world. In short, we expect an increase of cross-border activity due to the reasons I just mentioned. So where did all that money come from? A lot of it came from North America, Middle East, and Asia, as mentioned, and we expect especially the Asian money will be increasing rapidly. Two just case studies, starting with the one on the right. It's a very large office development in Brussels, 80,000 square meters, so 800,000 square foot. Led to the national police, bought by a Chinese. First Chinese who bought something in the Benelux, an investment volume of around 300 million. They did that with a German fund manager. Canadian pension fund who bought 4 multifamily resi blocks for 43 million here in Dublin. Just examples of cross-border, cross-regional investors into this market. And just to finally, I would like to conclude with what we call our heat map. As I mentioned, there are a lot of private equity firms selling out of London, but there is a huge amount of interest still in London for of long-term investors and who have a different horizon and a different yield profile. And then at the bottom, we see there's a lot of interest for these investors that are interested in taking a little bit more risk. They're going to Spain, Portugal, Italy. And 12 months ago, we would probably have Ireland also at the bottom here, but they're moving up a little bit to the major cities of Europe. And with that, I would like to conclude my presentation. I'm happy to talk to you afterwards or in the Q&A and answer any questions you may have. Thank you very much.